In this video, I'm going to share with you my step-by-step smart money trading strategy that has got me funded over $400,000 in the last 90 days. This is the exact strategy that all of my exclusive members use, and here's a sneak peek of some of the incredible results that they've achieved trading this exact strategy. In this video, I'm going to walk you through every single step. There are 4 steps in total. We'll start with the basics, but as things go on, it will become more and more advanced. As a bonus, at the end of this video, I'll guide you through a case study of a trade that both myself and all of the exclusive members took trading this exact system. You're going to get so much value from this video. Let's dive in. So step number 1 is understanding buy side and sell side liquidity. And what you're going to see within the market is a range high followed by a range low. And these are just simply swing points within the market. You have a swing low, followed by a swing high, followed by a swing low, followed by a swing high, followed by another swing low. And this is nothing more than a ranging market. And the first thing that you need to understand is, where is the buy side and sell side liquidity resting? Buy side liquidity resting above these significant highs. This could be the Asia session high. This could be the London session high. But first, what is buy side liquidity? It's basically just where the money is resting. This is in the form of buy stops, and this is also in the form of stop losses. Alternatively, we have sell side liquidity resting below these significant swing lows. This is in the form of sell stops, and also this is in the form of stop losses. However, the problem arises is what happens when price breaks out of this range. For example, right here, running all of this sell side liquidity. And the problem that most traders face is they see this as a breakout, but we see this as manipulation. All this move right here is doing is stopping traders out, thinking that this is a breakout, and enticing them short within the market. Not only that, any early buyers, their stop losses will be below these significant lows, and they will also be getting stopped out. So the solution is reframing your mind and seeing this as manipulation rather than a breakout. And alternatively, if we run the buy side liquidity, this move right here will be enticing breakout traders, thinking that the market is breaking out and that it's going to go to the upside. Not only that, any early sellers, their stop losses will be above here, and therefore they will also be getting stopped out within the market. And all this simply is institutions manipulating price, stopping traders out, grabbing the liquidity before they can move the market in the intended direction. So in order for institutions to actually sell in the market, they need to match up these institutional sell orders with retail buy orders, which will be in the form of buy stops, and which will be in the form of market execution of traders thinking that this market is going to go higher. Once they've engineered enough liquidity, institutions will then short the market to the downside, and that's why we often see fake breakouts within the market. Okay, that concept was good, but if you don't understand this concept, there's no way that you could ever become consistent with your trading. Step number 2 is understanding entry model. And a problem that so many traders face is not waiting for a confirmation. Let's say that you see this manipulation right here, running the buy side liquidity, and therefore you're looking for a potential short trade on the market. We need to see signs that sellers are actually stepping into the market. And so what you need to wait for is simply a 15-minute bearish candle, because this will indicate that sellers are present within the market and indicating that momentum is stepping into the downside. But it's not just a bearish confirmation that you need. You need to enter on the break of this candle low. So once you see the bearish candle, you want to enter on the break as price breaks the low of that candle. Then you're triggered short within the market, and then you can look at targeting lower prices. And you know, I've been in your position as well, where you may have a good understanding of directional buyers and where the market's likely to go, but without waiting for a confirmation, there's no way that you could ever time the market efficiently. And vice versa, let's say we run the sell side liquidity, therefore we're looking for a potential long trade on this market. So we need to see a 15-minute bullish confirmation like so, and we can enter a buy position on the break of that 15-minute candle high. Because if price is strong and showing momentum, price should then continue upwards, breaking the candle high. And then you can look to target higher prices. So if you've ever wondered where you have directional bias correct, and sometimes you get stopped out and then price goes in your intended direction, it could be something as simple as this. Waiting for a confirmation shows that clear momentum is stepping into the market, which will then increase the probability of your trade working out. Okay, step number 2 is incredible, but without step number 3, none of this makes sense. So let's say that we enter a buy position on the break of this bullish candle high. Step number 3 is understanding invalidations in targets. And a problem that so many traders face is micromanaging, closing trades early, moving stops to break even too early, and not allowing their trade to play out. So if we are triggered long in this trade right here, on the break of that 15-minute bullish candle high, the most logical place to place your stop loss is below the liquidity sweep. Because if price triggers us in and then breaks the low, this will indicate lower lows and lower highs within the market, and therefore that would completely invalidate our trade because market structure will be shifting bearish. So many traders have stop losses way too tight under, let's say, like 2-minute fair value gap, and it just doesn't make any sense. Your stop loss needs to go below the liquidity sweep, giving your trade a nice bit of room to breathe. And so having a mechanical stop loss and take profit will really help reduce your emotions within the market. I personally target a 1 to 2 with this strategy, and I've done all the hard work. This is from years and years of backtesting and data to support why I use this. So you can either take my word, or you can go ahead and backtest this yourself and find similar results. And so a mechanical 1 to 2 risk to reward allows you to just accept once you're triggered long in this trade and you've applied your risk, it's literally either take profit as hit or stop loss as hit. There's no micromanaging, there's no getting emotional, there's no closing trades early. Allow the trade to play out. And so many of my members in the exclusive community and members that I've mentored one-on-one have told me that this simple mechanical approach not only transformed their trading, but also made them very, very calm within the markets. And vice versa, if we run buy-side liquidity, we're looking for a shorting opportunity, and we see a 15-minute bearish confirmation indicating sellers are back in control. Of course, we enter on the break of this candle low, and invalidation would go above the liquidity sweep and target a mechanical 1 to 2 risk to reward. So if price on the next candle pushes down and triggers us short, we will have a predefined risk at the high and a mechanical 1 to 2 take profit. So this is just the opposite of the buy model. Step number 3 was incredible. But without understanding a directional bias and understanding whether you should be looking for buys or whether you should be looking for sells, none of this literally makes any sense. So step number 4 is understanding directional bias. We can do that in a very simple way by using this indicator. It's the EMA 50, 100, and 200 by Dr. Sweets. So add that to your chart, add that to your favorites. Okay, so a huge problem that traders face is trying to short the market, going counter trend when clearly momentum is to the upside. So for example, if you try to short this pullback, try to short this pullback, try to short this pullback, you would have got stopped out every single time. However, if you reframe your mind and you understood that the directional bias was longs on this market, buying these pullbacks made you so much more money. And we can do that objectively. And we can identify directional bias objectively when the 50 EMA is greater than the 100, which is greater than the 200. This indicates that we are long bias on this market. Therefore, when we turn up to the market, we're not looking for shorts, we're only looking for long. And this just ensures that you are always on the right side of the trend. You're not trading counter trend and you're sticking with the momentum. So this objective framework on identifying directional bias using these EMAs makes it completely black and white and removes all confusion. Okay, so now let's break down a case study of a trade that myself and all of the members took within the Toto Capital community. Okay, so first let me show you the analysis that was sent to all of my exclusive members, and here is the outcome of the trade. Okay, let me just rewind this back so we can break it down step by step. Step number 1 is understanding buy side and sell side liquidity. And we understand that there is sell side liquidity resting below the London session low. The London session is from 3 a.m. until 5 a.m. This is New York time. We also have the Asian session, which is 7 p.m. until 12 o'clock midnight. And we have the New York session, which is 8 a.m. until 10 a.m. Okay, so we're looking for a run of sell-side liquidity. You can see that's what we get right here. And what this will be doing is trapping traders, thinking this is a breakout, enticing them short within the market, and also stopping any early buyers from the London session because their stop losses will be below the London session low. So they'll be stopped out. We need to understand directional bias. So you can see right here, the 50 EMA is greater than the 100, which is greater than the 200. So this indicates that we are long bias on this market. I'm just going to remove the EMAs, but please keep in the back of your mind that we are long bias. Step number 2 was understanding our entry confirmation. And this was simply a bullish 15-minute confirmation after we've seen the run on liquidity. So that's this bullish candle right here. We can then enter a buy position on the break of the bullish candle high with invalidation below the liquidity sweep and simply target a 1 to 2 risk to reward. So this is using step number 3, which is understanding invalidations in targets. And we use a mechanical 1 to 2 risk to reward. So we're expecting price to push up and trigger us long in this trade. We've defined risk and either we're stopped out or take profit as hit. There's no in between, there's no micromanaging, and there's no getting emotional. We need to stay as objective as possible. You can see we're triggered in this trade right here, and then we've gone into a little bit of drawdown. You know, this is the part of trading. Not all trades that you take are going to go straight into profit. You can see we start pushing to the upside, and then we have a pullback right here. And this is where so many traders go wrong. Moving stop losses to break even too early, micromanaging, getting emotional, closing on these bearish candles, and not allowing this trade to play out. Remember, the markets move in waves. It's never just going to go straight to your take profit every single time. And you can see this trade hit take profit just before the Asian session. And this was hit for a mechanical 1 to 2 risk to reward. And I'm going to be honest, guys, I've been in your position. And so much of this is simply training your mind on becoming algorithmic to where you define your risk and you literally just accept that this is either a take profit for a 1 to 2 or this is a stop loss. And I know so many traders close this trade early within this area right here. And that's what's going to separate you from either being a profitable trader or a losing trader. It's often not to do with the strategy, but more to do with your trading psychology. If you're looking at becoming funded and consistently profitable, then make sure to join my free Discord community. The link is in the description down below. However, if you do want results faster, then make sure to join my exclusive community and also check out my one-on-one mentorship. The link is also in the description down below. I personally look forward to seeing you on the inside. Thanks for your time as always, and you take care, guys. Bye-bye.